July 24th, 2024. Every once in a while, you get one of these bear trend days where, it ends up being, 90 points, 100 points. You can see them, they're pretty evident on the daily chart. You have this one, you had this, we had this, we had this, and they're usually pretty difficult to trade because you're expecting the market to reverse most of the time. And the common theme in these days is um, that the entries really aren't all that great for the most part. They're reasonable, every time you get a bear bar closing near its low, there's problems with it. You're selling 30 points away from the moving average to start the day, right? So it's really hard to want to sell these bars when you're getting a doji bar, and then not a doji bar, but a bar with big tails, and there's a tail on 5, there's a tail on 6, and so on and so forth. So these days can be a bit more difficult to get into the market. And there's usually only, one or two relatively clean stop order trades on these types of days. And yeah, there is I actually remember when I first started trading, I saw one of these days happen, and I decided basically from that point on, anytime I got a gap in a big bear bar closing somewhat near its low, I was going to sell it. And I did that for probably 6 months and just lost so much money doing it. That it's really not worth doing that sort of thing. So, I think it's pretty inevitable as you learn to trade that you're going to end up sitting out on a lot of these days and thinking the market's constantly going to reverse. And especially if you're just starting, you're probably going to buy a lot of these reversals. Um, but that's how it goes. At first you buy the reversals, then you learn to sit out of the days, and then eventually you learn to get in on them. But my point being, these days are not all that common, because if you look at, how many large bear trend days we've had, we had a 90-point one here. This one, I wouldn't really count that, but 90 points, 85 points, 120 points, and 114 points. And if you look at that, we've had 4 of those days essentially in the past 77 days. So there's only really like a 5 or 6% chance that you're going to get one of these days on any given day. So it's not really worth it to bet on these giant bear trend days, because you're going to be wrong so often if you're doing that sort of thing. So my overall point being, these days are difficult. I thought 52 was the best trade on the day. It was the one that made the most sense. But I thought, honestly, the sell off from bar 1 to bar 39, there was a lot of issues with pretty much every stop order trade. So it was kind of difficult to get in, because even when the channel started over here, you'll notice that even if you took the sells, right? So you shorted below, maybe you made money on 13, but a little bit difficult in here. Maybe you sold below 19, but what are you going to do when you see 24, right? If you sold below 30, you're going to get out on 33. If you sold 36, 37, you're probably going to get out somewhere in here. So really, even if you took the sells in here, you ended up probably with a loss. And that's, one of the glaring issues with trading in channels. If you're trading in a bear channel, you want to be selling second reversals down from the moving average. You don't want to be selling, if you're selling down here, you're selling low in the trading range, where you can see limit order bulls were buying the lows and making money. So bar 1, a big bear bar. The gap down was pretty large. It was a little over 1%, I think. Just go from here. So yeah, a little bit under 1%, 1% gap down. Whenever you get a gap down that's this size, the odds of a trend day increase from about 20% to about 30%, and the odds slightly favor the trend day in the direction of the gap. So when you get this big gap down, odds favor the odds in general favor a trading range in some sort of wedge to the moving average, or a wedge and then a reversal up to the moving average, or a double top or a double bottom. So a double bottom down here, or a double top at the moving average. But if we are going to have a trend day, it's slightly more likely it's going to be a bear trend day when you get a big gap down. If you get a big gap up, it's slightly more likely that we're going to get a bull trend day than a bear trend day as well. If it was to be a bull trend day on days like this, a lot of times what you'll look for is if, let's say, one had closed, let's say you reverse bar 1, you flip it over. So let's do it this way. Actually, no, that doesn't make sense. If bar 1 had just been a bull bar, but the exact opposite, so it closed up here and its low was down here, let's say it closed on its high, that would be a credible buy for the low of the day. And that would be one of those situations where it's a 30% chance that that would be the low of the day. But I still think when you get bar 1, maybe it's 25% chance that we've seen the high of the day with bar 1, but there's a tail on the top, and I think the prominent tail on the bottom raises a bigger issue for the bulls, or sorry, for the bears. Bar 2 it's follow through for the Bears, and we have consecutive bear bars, but neither one of them is able to close on their lows, and the body is pretty small. So at this point, to me, this looks a lot more like it's going to be a trading range open than a bull trend from the open of any kind, or a bear trend from the open. Bar three, a doji bar. So we traded above two. Not surprising that there were sellers above two because it's a bad high one buy for the bulls. What do the bulls want? I think if you're a bull in this area, you're looking for you know, maybe a sell climax and a bear trap and then a big reversal up, or you're looking for some sort of, um, second reversal up. But ideally, if you're a bull, let's say bar three was a small inside bar closing on or near its high. Um, let's say bar three looked like bar 71 and it was an inside bar. That would have been a credible buy for the low of the day. Maybe only 35% chance that it is, but your risk would be small and your reward would be very large. So that would do a very good job at offsetting the probability. So sellers above two during three, but three is a doji bar. It's a low one short for the bears, but I don't think anyone really wants to sell below the doji bar. So it's better to wait for more price action. An outside down bar on four, so we're in breakout mode. We're probably going, a little bit lower. We have no bull closes yet today, so that's pretty important. Another thing, that's going to be important whenever you get the big gap down is the gap counts as the first open gap. So traders need to see, I'm just going to draw it this way rather than zoom out, but traders need to see two open gaps in order to think that it might be a bear trend day. And this with the gap with, yesterday's low and this high would be the first gap. The second gap ended up being the bar four low and the bar six high. Why was it that? So why is this a gap, right? Well, it's not really a very good sell below bar four. It's an outside bar. So we're in breakout mode and it doesn't close on its low and it's following a doji bar. If you're selling below four, you're selling, 35, 36 points away from the moving average and you're selling very, very average price action. So to me, when I see four, I think there's probably going to end up being buyers below. Does that mean you should buy below it? No, because we haven't had a bull close yet today. Probably just not worth doing. But again, there probably should be buyers below bar four. And instead, the bulls got trapped on bar five. So there were a lot of algorithms most likely betting against a bear trend from the open. And instead, they end up getting trapped and they're not able to scale in and make money. And so that is what leads to this trend day being able to happen is, all day, it kept trapping bears out. We kept getting bull bars that would trap bears out. And then a couple of times you can see the bulls got trapped in. So when you're trapping bulls in and trapping bears out, that's what can lead to the strongest trend days because the bears are chasing the market down all day. They keep getting stopped out and having to sell again. And the bulls keep getting stopped out because they keep trying to buy on limit orders and keep trying to scale in. And that's actually probably what happened towards the end of the day here on bar 77. Because we had the open gap with the bar. This was a wedge, right? 1, 2, 3, and we have the open gap with the 59 low, and we were trying to close it. That's why 73 reversed up so strongly. I think as we were trying to close the gap with this low. But when you get disappointing follow through and bulls give up, then all of a sudden bulls are trapped, and so bears can sell, hoping to get. There's actually a couple more points I want to make about this area. Something I heard Al say in a webinar recently, but I will get to that when I get there. So bar 5, a big bear bar closing near its low. It's good for the bears. We're probably going at least a little bit lower. You could argue breakout below some sort of micro wedge, 1, 2, 4, but I'm not really sure how much lower I think we're going. To me, it looks pretty climactic. And if you're choosing to sell here, you're selling 38, 39 points away from the moving average. And again, if you're doing that, every once in a while, you're going to be right. But I think the overwhelming majority of the time, you're going to end up being wrong, and you're going to get some sort of disappointing bar. 6, it's follow through for the bears, but it's really not all that good. It's notable that we haven't had a bull close yet today. However, there is a really large tail on the bottom of 6. So to me, this is disappointing for the bears, and they might start to exit. But instead, we get another bear bar closing near its low on 7. The problems with selling 7 are your stop is very far away. It's above the bar 4 high, and most traders do not want to risk that much. This whole sell-off, it's kind of like, musical chairs a little bit. It didn't, today's not a good example, but a lot of times what will happen is you'll end up getting a big bull bar and the bears will just give up, something like this, but it'd be over here, and the bears just give up. And so the bears who had been selling are going to be very quick to get out down here because they know there's real risk of some sort of, disappointment bar and a bounce, simply because we're so far away from the moving average. Most traders don't want to sell 40 points away from the moving average. So you can sell down here. It's a reasonable thing to do to sell below 7. But you have to be quick to get out and you have to be quick to make decisions. And when you see bar 8, you're probably in a pretty difficult spot because if you sell below 7 and you see 8, I would imagine you're pretty disappointed in how that bar looks. And so some traders might choose to use the start of the sell off on 9 to exit their short at break even. But instead, we get a bear bar closing near its low on 9. To me, this looks like a parabolic wedge. 1, pullback, 2, pullback, 3. So some sort of wedge, parabolic wedge open. What do the bulls want? Well, the bulls want some sort of reversal bar and that they can buy for a potential low of the day. However, the first reversal up is probably going to be minor and not go that far. This has gone down pretty far. If you were a bull, you were probably hoping for, bar 6 maybe, hoping that bar 5 was going to be a sell climax and bar 6 could close on or near its high, and that would be a credible high 2 on the open. But this has gone on a little bit further than bulls would have liked. So while it is a parabolic wedge, I think if you're a bull here, you're just waiting for a bull bar closing near its high, but you know that the first reversal up is probably going to be minor. 10, disappointing, a doji bar. What do you do here? I don't know. I think if you sold below 9, it's kind of tough when you see 10. It's hard to stay short here because, 10, 11, 12, you get 2 bull closes, or you don't really have to exit above 12, but this whole scenario is a little bit difficult. And I don't really want to be long either because the bulls have not done anything, today to prove to me that I should get long. But sellers above 10, not that surprising. It's a bad high 1 for the bulls. A bad low 1 short below 11. So limit order bulls will buy below 11. What are they betting on? They're betting on a second leg sideways up. Then you know that most bears are not going to want to sell below a bull bar on 11. And so they're basically just betting that we're going to get some sort of bounce like we did on 12. And they'll be pretty quick to scalp out of their trade. And so outside up bar on 12, and you can see we rallied and then we sold off, traded below 11, and then we rallied again on 12. So this, it's kind of hard to look at, but 10, 11, 12, I think qualifies as 2 legs sideways up. Does that mean that we're going a lot lower? No, I didn't think we were going a lot lower in this area. I was a bit surprised when we did get the breakout on 19 and we got follow through. But the one thing you have to remember is at this point, we're getting relatively close to the big round number 5,500. And while I don't think it's all that ideal to be selling in here, it's probably okay to sell and take a chance. You're trying to make about 15 points. Take a chance we get to 5,500. I think the same argument could be made for 19, and that's why 19 was a credible sell, because you're trying to get basically to the magnet. So 13, I think you could say low 1, 11, low 2, 13. So it's a low 2 short for the bears. However, you're still selling, further below the moving average than I'm ever going to sell. So I don't want to sell 25 points below the moving average. You can do it if you want to, but again, for me, I just, when we get this far away from the moving average, I tend not to trade until we start to get closer to it because it's pretty unusual. 14, follow through for the bears, but a big tail on the top. 14 overlaps 13 a lot, and it is not able to close at a new low. So it's not able to close below the bar 10 low, making this a little bit less bearish. An inside bar on 15. Inside bars are low 1 shorts. So we broke out to the new low and pulled back on 14. And now we have an inside bar, low 1 short on 15. It's not really worth shorting. I think I would rather wait. If you are short, it's important to note that we were always in short the entire day. So we never went always in long. So theoretically, when the market is always in short, any bear bar closing near its low is a sell. But obviously that doesn't apply as much in trading ranges. And so you have to decide, is the market in a trading range or in a trend? We're obviously in a trend here, but the question becomes, when are we going to convert into more of a trading range? 16, you can see there were buyers below 15 in a reversal up. Failed breakout below the low of the day, but it's not worth buying 16. You wanted the bar to look better. Maybe close on its high or be a little bit bigger, but instead you just get a doji bar. 17, an inside bar, low 1 short for the bears. To me, this looks like it's becoming some sort of final flag. We might have to go a little bit more sideways. And if you were watching 18, 18 formed most of its range within, like 30 seconds, basically. It just bounced because bears, you would think at least the bears were starting to give up. So a lot of traders were buying the market, betting the bears were going to give up, and we were going to get some sort of reasonably good bull bar, maybe bounce to the the high of the channel, maybe up here would be a reasonable target. We're probably not going to get all the way back to the bar 4 low. That would probably be the target for the bulls had we started to convert into a trading range in here and gone more sideways. But at this point, it's a little bit suspicious. So we are only on bar 16, or sorry, bar 18. So it doesn't mean we're definitely not getting back here today, but it's definitely not the first target for the bulls. So we probably, if we're going to rally, it's going to go more sideways first and probably sell off at the moving average. We've been below the moving average all day. So I think that we're probably going to find sellers the first time we touch the moving average. And then we get bar 19, a bear bar closing near its low. I think bulls were trying to get a reversal in here, but the big round number was a very strong magnet below. So more traders willing to sell below 19, taking a chance they can make 8-9 points to the downside and get out of their trade around the big round number of 5,500. 20, a doji bar. So, that's tough, right? If you sold below 19, you did not want to see a doji bar on 20. So while it's okay to stay short and we're still always in short, it's a bit difficult to want to be short when you're getting a doji bar as follow through. 21 is an inside bar, so it's another low one short for the bears. Again, you're trying to get a big breakout to the downside, but it's really hard to bet on that at this point, or a vacuum test of 5,500, but it's really hard to bet on that at this point, I think. 22, a bear bar closing near its low. So some traders will sell the close of 22, and they're just looking for basically one more bar down to the moving average, maybe make a 5-point scalp, or sorry, down 5,500, and maybe make a 5-point scalp, which you can see they were able to make almost exactly that. 24, a reversal up for the bulls, but I think this is mostly just bears taking profits. We're still reasonably far below the moving average. It's been coming down a lot, but we are at the magnet. I think 5,500 was the goal for the bears, so we're probably going to get some sort of bounce here. I'm not sure how high. You could argue that bar 21 or bar 20, this would be the most recent sell climax, 21, 22, 23. So we might have to get to this high. I think the next target for the bulls, the 18 low. You can see the bulls who bought below 18 probably should not have lost money. And you can see they ended up getting trapped and remained trapped all day. So we have another open gap here, the bar 18 low. But the breakout point, the actual breakout point, was the bar 16 low. And we did overlap that on the bar 25 high. So a lot of limit order bulls were able to make money. So 25, follow through for the bulls. We have consecutive bull bars, but neither one closing near their high. 24 is reasonably big, but you probably want it to be bigger if you're going to be looking to buy in here. And, I think one of the things that you should start to, in general, think about if you're looking to buy in moves like this is never buy in the like stuff like this that's kind of towards the middle. You don't want to buy this. You want to buy reversals up from a lot lower to give you room, because if you think about it, if you're thinking the trading range starts here, which is a reasonable thing to think, right? So the channel started here. If you're buying above 33, you're now buying in the exact middle of the trading range, the exact middle actually. So you want to be buying, had 42 closed on its a high, that's a more reasonable buy because you're now buying in the lower third. So even though it's a bear channel, if you're buying in a bear channel, you're saying, I think this is a trading range and I think we're about to convert into a trading range. And if it is a trading range, you should treat it the way that you're supposed to treat trading ranges, which is buying small bars that are reversing up from low and selling small bars that are reversing down from higher in the range. So that's why in bear channels, it makes more sense to sell closer to the moving average because you're selling higher in the bear channel. It only makes sense to buy reversals up from very low in the bear channel. You don't want to be buying in the middle of the bear channel. So hope that makes sense. But anyways, 26, it's an inside bar. It's probably going to be buyers below. It's 3 straight bull bars. So I would imagine we're probably going to get some sort of second leg sideways to up. 27, a bear bar, but a big tail on the bottom. Again, I think we're going to get a second leg sideways to up, 24, 25, 26. 26 is not a good low one short for the bears, so I'm expecting a bit of a bounce here. Buyers below 27 during 28. Probably sellers above 28, but you're still expecting a second leg up from 24, 25, 26. So this is one of those situations where we might bounce a point or two above 28 to get the second leg sideways to up from 24, 25, 26, and then find sellers. So bears will wait until we get a point or two, maybe close to the bar 26 close before they start to sell. 30, a bear bar closing near its low. Can you sell 30? Yeah, we're always in short, and it is sell to close, but there's a lot of problems. You're selling right near a big magnet, 5,500. You're selling basically near the close of bar 20, bar 23. So you know there's probably going to be buyers not too far below right here, and so this is a difficult area to look to sell. 31 follow through for the bears. It is consecutive bear bars, yes, but I don't know how much lower we're really going here. I think that the bear channel and more of a trading range started on bars 24, 25, and 26. So to me, I think that we're probably going to end up going a lot more sideways in this area than anything. So again, the recipe for these types of channels is to look to sell reversals down from the moving average, not really sell low in the range like you would be doing here. 31 follow through for the bears, but it's a really small bar. We might go again a little bit lower, but I'm not sure how much. 32 more follow through for the bears, but bulls are going to be fading the breakout below the bar 23 low, betting they're going to be able to make money on limit orders. And that's exactly what happened. Bar 33. So, or on bar 33, those bulls were able to make money. Problem with 33 is it got too big. Had it been a small inside bar closing near its high, then it would have been more credible. But instead, 33 got big and made the risk large. Now you're buying in the middle of the range. You want to be buying smaller reversals up from the low of the range, and you're not able to do that here. So it's a bit disappointing. 34 disappointing follow through. We might have to get to the moving average pretty soon here. In general, when you have a bear trend day and then the market starts to go sideways, you should expect it to go sideways for an hour or two and then try to resume. Usually, if it's going to resume, well, first off, the stat is that I think it's 60% of the time. Yeah, it's 60% of the time when you have a bear trend day, the market's going to go sideways for the remainder of the day. So sorry, let me restart. 60% of the time when you have a bear trend from the open, the market is going to start to go sideways. In general, 20% chance of a big reversal down at the end of the day if it does go sideways, and 20% chance of a big reversal up. Obviously, the market is always in short, and so there's a slightly increased chance of us going down instead of us going up. But you usually want the market to go sideways for a couple of hours and then look for a reversal. Usually you would look for the reversal around bar 40, but this has gone on longer than most bear trends from the open. Usually a bear trend from the open will last the first, I don't know, 18 to 20 bars, and then it'll go sideways, and then you'll get a reversal up around bar 40, which is about 20, it is 22 bars later. So once you start to go sideways, 26, 27, in this area, you're probably looking for a reversal around bar 50. But anyways, 34, disappointing follow through. 35, triggered the low one short below 34, but that's not a very good sell. It's a bull bar. 36, consecutive bear bars closing, 36 closing somewhat near its low. And I think you can sell it, but I have all the same problems with 36 that I had with bar 30. You're selling towards the bottom of the bear channel, and this is more of an area where you want to be looking to buy reversals up after a failed breakout of the new low. I'm not really that sure you want to be selling here. You know that the bears are going to take profits below bar 32 if we get there. So, and tough call when you see 37, right? If you were short below 36, what do you do when you see 37? Well, I don't know. It's not really what you were hoping to see. 38, the bear bar closing near its low. We are always in short, so you can sell it, but you're betting on a breakout below. I think we have a wedge forming here, 23, 32. And then I didn't know it was going to be 39 at the time, but I figured sometime within the next 4 or 5 bars, we were going to try and get a bounce. So this is the spike, and now we're forming a wedge channel. So 39, follow through for the bears, but now this looks like a wedge, 1, 2, 3. So it's not worth selling below 39. You probably have to wait to see if you get a breakout on 40 or 41. And instead, it never triggers, and you get the big disappointment bar on 40, a big bull bar, a tail on the top. Really large bull bar. So I think we're going to go sideways for an hour or two. 41, a bear bar closing somewhat near its low, but you can see it's just testing the bar 39 close. I don't really want to sell here. If you're selling, you're betting on a breakout below the wedge channel and some sort of measured move down. And I think we need to go sideways first. We haven't touched the moving average at all yet today, and it would be very, very unusual for us to not touch the moving average. We usually touch it by 1:30 Eastern Standard Time, which we were able to today. But usually, even in the trend days, the market does touch the moving average by that time. So you don't really want to sell over here, especially that 40 is big enough to get a second leg sideways to up. 42, a bull bar, but not able to close on its high. an inside pattern, 41, 42. So it's a final flag for the bears in a breakout mode pattern. So it's probably reasonable to buy above 42, but I don't really want to do that. And you're just betting on a test of the moving average. So 44, you're taking profits. This is not a buy the close bar. This is a profit taking bar. Really what it is it's a give up bar. It's the bears admitting we're now in a trading range is really all this is. So if you looked at 44, so let me just get there. Hold on. 42 tail on the top, probably a minor reversal. So we might bounce, for a couple legs sideways top, maybe towards the top of the channel, like around the bar 26 close. We didn't quite get there, but no, that was probably the area the bulls wanted to get. 43, it's kind of disappointing follow through because bulls weren't as eager to buy above 42 since it had a tail. Now we have a doji bar 43, but it is still a bull bar. And at a certain point in every bull trend, the bulls are going to give up and the bears are going to give up in the bear trend and admit the market is in a trading range. And that's what's happening on 44. So what this is bears who sold anywhere for any reason deciding, okay, I probably have a decent profit, or I think the market's going to start to go sideways and I'm going to get a chance to sell higher. And they just exit their shorts. And that's what causes 44. So all the bears have given up at this point. So in order for the market to continue higher, the bears have now given up. Now the bulls would have to buy. So you don't want to be the bull taking a chance buying here. Why not? Because what are the odds that this is going to convert into a really strong bull trend? Very low. If you're taking the buy above 44, it's a clear swing trade. But the problem is the risk is large and your probability is not very good. So you're risking 11 points. And to be honest, if you're buying above that, you're basically betting that bar 45 is going to look exactly like bar 44. Though you have to be able to manage it correctly. If you can manage it correctly, if you buy and you're willing to scale in, or you're really quick to get out, you can probably do it. But it doesn't make a lot of sense, I don't think, because the bar is so large, and you're now buying high in the trading range. So the only the only remotely logical thing you could do buying above 44 would be bet we're going to fill the gap over here and bet this whole thing is just, you're not betting this is a trading range. You're betting all this is a trading range. And you'd be betting that this was all just a leg in a trading range. And that does not seem very likely. So basically, if you bought above 44, 45 also has to look like 44. And you basically need the market to race up, trapping bulls out, and bears who are starting to sell up here, betting this is a trading range, thinking they're selling high in it. You're hoping they're going to get trapped too. So you're risking like a 10 or 11 points. And yeah, you're trying to make, 30 points, but I don't really think that that's worth it at all because it's a very low probability that we're going to get back up into this area. 45, a low one short for the bears. I would not sell below 45. I would rather wait. We're probably going to go sideways for a little bit longer. I don't know how much longer, but in general, look to sell a strong second reversal down. 46, that 44 was strong enough to get a second leg sideways to up. And 46 could be that second leg sideways to up. The bulls are hoping it's a high one for their bull trend, but it's not a very good high one. There's a big tail on the bottom and the top. And, you did not want to have to buy a high one. If this was going to be a bull trend, you wanted the market to race up. 47, an outside bar, but really not worth doing anything. Tail on the bottom, tail on the top. So I think we're just going to go more sideways. 48, a bear bar closing near its low. I think we're going at least a little bit lower overall, but let me back up. Consecutive bear bars. So are we always in short still? Yeah, but it's probably not worth selling because you have the breakout point, the 43 high. We're probably going to get a second leg sideways to down is what I should have said from 47, 48, but I don't think it's worth selling. You're selling in the middle of a trading range. 49, a bull bar closing near its high. Do you buy above 49? I probably wouldn't. It's a high two for the bulls, and the bears are hoping it's a pullback. So a breakout pullback. What's more likely? Probably the breakout pullback, but it's not a very good breakout pullback. Again, I would just rather wait. It's better to do nothing, but we're still always in short. 50, a big tail on the top. Bears trying to get some sort of double top bear flag. Bulls hoping to get follow through to the upside here, but they need it. They need it very quickly. And then 51, disappointment. It's 3 straight bull bars, yeah, but it's really not all that good. And then you get 52, and 52 is a credible trade. The problem with it that you can obviously see is that you'd be selling in the middle of a trading range, or maybe even the lower third. So towards the lower third of this trading range. And so you would, I'm sure you're sitting there saying, well, you said don't sell 48 because of that exact reason. You're right, I did say that. But to me, if you're selling 52, your premise is now the bear trend is back on. So you can sell below 52, bear bar closing near its low. And what you're betting is that the bear trend is resuming. So here, this just still looked like a trading range, but you're getting a credible second reversal down over here. So, it's easy to look at this and still think we're in the trading range, and we might be. But if you're selling below 52, you're betting the bear trend has now resumed. So I don't think it's worth betting on that over here because I think we're still going to get a second. We still need to get a second reversal down. But I think that it's more likely to bet on that over here. And additionally, the bulls who bought below 51 probably should not have gotten trapped. And they see 52. If you buy below 51 and you see 52, you're probably thinking to yourself, whoa, that is not what I wanted to see. So those traders might be forced to exit their longs. So 52 is credible because of this. You're betting on a second leg down from this. And when you think about it, this whole thing is a breakout on a higher time frame. So if you look at let's look at like a 30-minute chart. You can see the whole thing. This is around where that second reversal down was. This whole thing is a bear breakout on a higher time frame. So even the hourly chart, right? Bear breakout. So as many pullbacks and stuff as there was in between, you still need to think of this whole thing as a breakout and imagine that we're probably going to get a second leg down from this whole thing. So you can sell 52, betting the bear trend is resumed. I think that is the best trade on the day. Follow through 53, consecutive bear bars closing near their lows. The body is shrinking, which is bothersome, but it's still okay to be short. More follow through 54, but a tail on the top and a tail on the bottom. Another bear bar closing near its low, 55. Again, 4 straight bear bars. You know this is going to get a second leg sideways to down. We might get a little bit of a bounce before we get the breakout to the new low. I think if there was a lot of eagerness to sell so far, then we probably would have already gotten to the new low. Some bears taking profits with a 5-point scalp, so they were able to make 5 points exactly at the low of 56, and that's what caused this profit taking was the bears who sold, and they see the 4 straight bear bars and they know that it's probably reasonably bearish, but they think to themselves, yeah, well, we still might be in a trading range. I thought the breakout was going to be stronger. So they'll scalp out with 5 points. They have 0 true risk, so it's reasonable to do that. And they exit with 5 points, and that's part of what causes 56. Sellers above 56 during 57. Maybe some sort of 2-legged correction on a lower time frame. To me, I was a bit suspicious that we were going to stay in a trading range, but these were strong enough for a second leg sideways to down. So if you are short, it's still always in short, and you don't have to exit in here. So you can just wait, and then you get 58, a bear bar closing somewhat near its low. It's disappointing it wasn't able to close below bar 56. You want to get a really strong bear bar breaking out to a new low. You can sell below 58, betting that we're back in at least a bear channel, and you're selling reasonably close to the moving average. But you need a good follow-through bar. If 59 is any sort of bull bar, you're just going to get out. And instead, you get follow-through on 59. There's a big tail on 59, so I think that's a little bit disappointing, showing that some traders are scalping out. You can see, I don't know if they were able to make 5 points. They were not. So it went 5 points, but the market has to go 5.5 points in order for traders to make 5. 60, an inside bar, a bear bar closing near its low. It's a low one short for the bears. So can you sell it betting the bear trend has resumed? Yeah, it's just a bit difficult, I think. But it's a bear bar closing near its low. We're always in short. It's okay to sell. 61, more follow through. So tail. We might start to go a little more sideways here, but it's definitely still okay to be short. We're always in short. We're getting bear bars closing near their lows. 62, a disappointment bar. I think a lot of bull bears will start to exit if we trade above it. And that's why you get 63. Bears sell to close, trying not to let it trigger. They have their stops above 62, so their risk is really small, and it's a reasonable thing to do. Am I selling 63? No, I would just be done. I would be done selling for at least a little while, and probably the rest of the day at this point. Besides, there's an exception over here, but we have a wedge 49, 54, and 59. So we have an attempt at a wedge here, and 63 is the breakout below the wedge. So the bears want to get a measured move down to maybe here, which is where we got. But the problem is this is really climactic on 63. I mean, if you look at it real time, do you really want to sell that and bet on a new bear breakout? I don't. I would rather look and see if we get a reasonably good-looking bull reversal bar and then look to buy that instead. So I do not want to sell 63. Again, it is always in short and it's a bear bar closing near its low, but this looks like a climax to me. It's literally the best looking bear bar we've had in the entire day. So look at the whole day. It's bigger than 52. So it's bigger than any other bar. It's the best looking bear bar we've had the entire day. So you're selling a big bear bar closing near its low, 63 bars into a bear trend. That's really not a recipe for success. 64, follow through, consecutive bear bars, but tail on the top, tail on the bottom. 64 overlaps 63 a lot. You can see a lot of traders chose to sell around a 50% pullback on 64. Didn't get filled because it didn't go one tick above 64, so showing a little bit of urgency. And obviously, we have this open gap now with the breakout point. 65, if 65 had closed on its high, it would have been good for the bulls, and the bears would have to get out. But instead, it's a bear body. The context is good for some sort of bounce here, but I think that you can't buy above a bear bar. 66, probably sellers above 65, scaling in higher. So 66 is a good looking bull bar, but a tail on the top, so not really. There's nothing to buy here. You're maybe looking for a second reversal up, but I would just rather wait. Let me clear this. 67, a bear bar, trades below 66, triggers the low one short below 66. Not very good to sell below a bull bar. That's this strong. 68, another bear bar, but a tail on the top and a tail on the bottom. An inside bar, doji 69, not worth buying. This is kind of similar to this in that I'm probably looking to buy in this area, but I want to buy a small bar reversing up from the low. That's kind of the problem with 71 even. It's credible. It's an IOI, so outside down bar 70, but not worth selling. It's probably a second leg down, and you're probably selling the bottom of a trading range. This doesn't look like a bear trend anymore. But 71, yes, it's a bull bar closing near its high, and you're selling low in this overall range. But I want to sell low in the tight trading, or sorry, you're buying low in the overall range, but I want to buy low even within the tight trading range we have from this area from 65 to 67 high. I'd like to buy a reversal up from the lower third of that, and it's not letting me do that. So, but bears are going to exit above 71 for sure. And instead, we get a big bear bar closing near its low 72. You'd like a small reversal bar up on 73, but this is one of those days where the market was never giving you what you wanted. And you get a big bull bar closing near its high 73. The risk is really large, would be the problem with 73. Can you take the buy above 73? Yeah, but you have to know how to manage it. If you are going to buy above 73, you have to recognize that your risk is large, and so a lot of traders might sit out. What's your profit target? Well, you know that the 59 low would probably be the first target for the bulls, considering that we have an open gap with the breakout below the wedge. An open gap with the breakout below the wedge. But the problem with using that as a profit target is you're risking 10 points trying to make 6. So how good, it's really not all that great. And I'm not sure the probability is high enough to justify that. So if you're buying above 72, you could also be betting on some sort of short covering rally. I don't know how high we're going to go though with the way the day has looked. And you could always just wait to see if you get more bull bars. But if you're buying above 73, you want to see 74 pretty much look exactly like 73. You want to basically see the bears get trapped and, we get some huge 25 point rally to finish the day and put a big tail on the top of the bear bar on the daily chart. You have to also note that we have credible reversals up on 71 and 73, good bull bars closing near the highs. When you get two credible reversals up, if you run both the stops, the market's going to try and go for some sort of measured move down. So I think that's what was happening on 78, is that there were bull stops here who were buying, hoping to get a good bounce, and we ran them. And so the market will usually try to get some sort of measured move down. There wasn't a clear one today, but usually we'll try to do something like this. We didn't reach this one here. I don't know, maybe we went to the midpoint of the two. That would be the low of 77. Sometimes the market will go to the midpoint of two measured moves, but it's not really worth. That's just something that, I used to be very obsessed with measured moves, and I would look for them within everything. And so that was something that I kind of figured out through a lot of trial and error. 74 is disappointing. So if you bought above 73, you do not like 74. And this is another one of those trades where there's no room for hope. If you bought 73, you see 74, you just get out around break even. And then you get a big bear bar closing near its low 75. Do you sell below 75? I think you can. It's a second reversal down, closing near its low or on its low, and it's a reversal down from the moving average. And the bulls didn't get any strong closes above the moving average. It's true they had a few strong closes, but they had a chance to go up here, and it seems like they kind of blew it. So it's okay to sell below 75. I think betting on a breakout below the bar 72 low and possibly a measured move down. So basically, if you're selling below 75, you're hoping the market gets below 72 and then see what happens. 76, a doji bar, or it's a bear bar, but you can see we basically traded back down to the bar 72 excuse me, 72 close, and some bears bought back shorts, which is not ideal if you're short. But sellers above 76 after three straight bear bars, and then a huge climactic bar 77, creating that measured move. If you see 77, you should just get out. Can you hold and take a once a year bet that we're going to end up getting some sort of massive sell to close finish? Maybe, but I mean I would get out of my position personally. And if you're holding, betting that that's going to happen, you cannot hold and get out above 78. As 78 is bouncing, you just need to give up and get out, because odds are that you're not going to get that sort of thing. So most likely your profit's going to get erased. Again, the largest bear bar coming 77 bars into a bear trend, not ideal. So profit taking 78, 79, 80. For stop orders on the day, I honestly, these are sell to close bars, and you can do it, and you could sell 13, and you can sell 19, and you can sell 22. You can take all these trades, but I think they're really hard trades to take, and they're not A plus trades. And I think that if you're a trader, especially if you're newer, your goal should be to take the best one or two trades every day. So yes, these are technically sell to close bars, and you can do it. But I think 52 is the best trade on the day, and then you can sell any of these closes. But the risk is getting large and towards the bottom of a possible trading range, so maybe not quite as good. You can sell below 60. I would not sell 63. So I thought 52 and maybe 75, if you're still trading, are the best trades on the day, but specifically 52. So on the daily chart, again, I mentioned over here on my July 17th video, when you get the gap down, so you have a bull bar closing near its high, then you get a gap and a bear bar closing near its low, it'll often lead to a swing down. This might be a leg one, leg two of some kind. Hold on a second. Just let me look for a second. So maybe that and then that, or something like that. You can see my point. Leg one, pull back, leg two. So we might be getting a leg one, leg two, but this is a really tight channel down. I'm not sure how far down we're going to go. This is a pretty good move. So I don't know, maybe we get to 50%, but I'm not sure we're going to get there all that quickly. We're probably going to have to pull back first. I thought 5,500 was the obvious magnet. We're definitely going to have to fill this gap in, I think, because this is looking like a leg in a trading range. So is it possible we just get a vacuum test all the way down to here over the next couple of days? Yeah, but I think probably a couple hours of sideways to up trading tomorrow. The weekly chart, I think how this week closes is important. If you get strong consecutive bear bars closing near their lows, it's very possible that we get back down to 5,000 at some point. Let me get some water. It's very possible we get back down to 5,000, and the trading range is from 5,700 to 5,000. If you look at the weekly chart, it doesn't seem like an unrealistic thing to do. However, how long is it going to take us to get down to 5,000? Well, I mean, it might take the rest of the year. This is probably not going to go straight down. It'll probably be a couple of legs sideways to down. We'll probably get bounces along the way. Come on. So yes, we might end up getting back down here, but I think it's reasonable to think this is the high of the year, the 5,700. It's very reasonable to think this is the high of the year, and we've put the high in. So we might start to go sideways within the range of 5,000 to 57, whatever this high was for the remainder of the year. The monthly chart, we're getting close to the end of the month, and it's a bear bar closing near its low. The bears, they want this to close on its low and basically think that this is a bull trap, and that we're going to get a reversal back down to at least 5,000, the close of April, and maybe back into this range overall. But I don't think we have enough information to do that yet. So it'll be important to see if this bar can close on its low. And yeah, that's